Welcome to Drift Shield, where we break down complex automotive technologies, vehicle data security, and modern car ownership trends. In this comprehensive video guide, we are conducting a deep analytical review of telematics and usage-based insurance programs, specifically focusing on pay-how-you-drive smartphone tracking applications. Many drivers are looking for ways to reduce their monthly expenses, and insurance companies are actively promoting mobile tracking applications. However, beneath the promised discounts lies a complex system of constant data collection, real-time risk assessment, and intricate privacy agreements. Our goal today is to examine how these tracking applications function and how your daily habits influence your monthly rates. To understand how pay-how-you-drive insurance works, we must first examine the core technology known as telematics. Telematics combines telecommunications and informatics to collect real-time data directly from your moving vehicle using your smartphone hardware. Modern mobile applications leverage internal sensors, including the Global Positioning System receiver, the accelerometer, and the gyroscope. By analyzing these inputs, the application can determine exact vehicle speeds, acceleration rates, cornering forces, and rapid deceleration events. This steady stream of driving metrics is transmitted directly to cloud servers, where advanced computer algorithms calculate your overall driver risk score. Traditional auto insurance pricing relies primarily on demographic data, historical statistics, age categories, and prior claim histories. Usage-based insurance completely flips this traditional evaluation model by shifting the focus toward your actual real-time behavior on the road. Pay-how-you-drive programs establish customized monthly pricing according to your personal driving habits. For responsible drivers who practice defensive driving and keep usage low, this approach offers an opportunity to lower recurring monthly costs. However, your monthly premium is no longer a static expense, as it fluctuates based on your ongoing driving metrics. This leads to the reality of constant collection. The app tracks your movements 24/7, creating a detailed digital footprint of your life. Every driver must examine the privacy trade-offs. Understanding what happens to your personal location data is essential before opting in. In conclusion, telematics offers potential savings, but it requires a balance between cost reduction and digital privacy. Stay informed and stay safe. Thanks for watching Drift Shield, your guide to the future of automotive technology. One of the primary metrics monitored by usage-based insurance applications is braking behavior, which insurance algorithms treat as a critical indicator of accident probability. Telematics applications calculate the rate of velocity drop over precise time intervals to detect sudden stops, which insurers label as hard braking events. Frequent hard braking suggests that a driver may be tailgating other vehicles, driving too fast for conditions, or failing to pay adequate attention. While hard braking can sometimes be the result of safe defensive maneuvers, repeated hard braking records will consistently lower your safety score. Over time, a low safety score resulting from frequent sudden stops directly reduces your policy discount or elevates your overall insurance rate. Rapid acceleration and aggressive cornering represent two additional driving metrics that telematics applications evaluate continuously during every trip. Smartphone accelerometers and gyroscopes measure sudden forward G-forces as well as lateral side-to-side forces during sharp turns. Applying heavy pressure to the gas pedal generates rapid acceleration logs, which algorithms associate with risky behavior or aggressive driving habits. Similarly, taking sharp turns at higher speeds creates strong lateral motion signals, indicating that the vehicle is turning without proper deceleration. Telematics algorithms flag these high-G maneuvers as unnecessary mechanical stress and elevated collision risks, which negatively impact your monthly performance rating. Vehicle speed is another vital factor that directly influences your pay-how-you-drive safety score and monthly premium calculations. Telematics applications cross-reference your global positioning system location with stored mapping databases to compare your vehicle speed against posted speed limits. Exceeding posted speed limits, particularly on city streets or through active construction zones, generates negative markers on your driving profile. Furthermore, telematics systems track overall velocity stability, recognizing that maintaining smooth and consistent speeds is far safer than erratic speed fluctuations. Consistently driving at or below posted speed limits demonstrates controlled behavior, directly protecting your eligibility for maximum premium discounts. The time of day you choose to operate your vehicle plays a significant role in determining your usage-based insurance pricing structure. Actuarial research proves that driving late at night, particularly between midnight and 4 in the morning, carries a significantly higher risk of accidents. Reduced visibility, increased fatigue, and a higher presence of impaired drivers make late-night roadways far more dangerous than daytime streets. Telematics tracking applications record exact trip start and end times, applying higher risk multipliers to late-night travel. Even if you drive safely, driving regularly during late-night hours can offset your scores and diminish your expected monthly savings. Total mileage driven remains a core component of usage-based insurance, often combined with driving quality metrics to determine total costs. Pay-as-you-drive models specifically calculate premiums based on the cumulative distance your vehicle covers over a given billing cycle. Every additional mile driven statistically increases your exposure to potential roadway incidents, traffic collisions, and mechanical failures. Telematics applications automatically record total trip lengths and aggregate your monthly mileage, rewarding low-mileage drivers with substantial price reductions. Remote workers, public transit users, and individuals with short daily commutes stand to gain the most financial benefit from these mileage tracking mechanisms. Mobile-based telematics applications also actively monitor smartphone screen interactions while the vehicle is in motion to detect distracted driving. By utilizing touchscreen registers, gyroscope sensors, and display activity logs, the tracking application can identify when a driver unlocks their phone. Distracted driving is universally recognized as a primary cause of modern vehicular collisions, making this metric heavily weighted within risk-scoring algorithms. Even brief instances of hands-on phone usage while driving can trigger severe point deductions within the application. While pay-how-you-drive applications promise significant potential savings, drivers must understand how these tracking systems handle data collection terms and conditions. Enrolling in a telematics program requires granting extensive permissions, including persistent access to location services and physical activity tracking. The tracking software operates quietly in the background, continuously logging exact routes, stop duration, travel frequency, and real-time movements. For consumers who prioritize personal privacy, allowing continuous digital monitoring of their daily movements represents a notable trade-off for reduced premium rates. Standard privacy policies detail the encryption protocols used to protect sensitive location records from unauthorized access or external data breaches. However, many agreements reserve the right for insurance providers to share or sell aggregated, anonymized driving trends with third-party data brokers. In the event of a traffic collision, the detailed telemetry logged by the mobile application can be subpoenaed by court order. This digital record provides an unyielding timeline of events that can either vindicate a driver or prove liability during insurance claims disputes. Insurance companies can analyze pre-collision telematics data to verify facts, assign fault, or potentially deny coverage if policy terms were violated. Smartphone applications represent the most convenient method for consumers, requiring no additional hardware installation inside the vehicle. However, mobile apps are prone to contextual errors, such as misidentifying whether you are driving or riding as a passenger in a bus or train. Onboard diagnostic plug-in devices provide much more accurate vehicle speed and mechanical data without relying on smartphone battery power. Certain insurance companies advertise that participating in telematics monitoring will never result in a rate increase, positioning it as a risk-free discount. Conversely, other insurers utilize aggressive dynamic pricing structures where dangerous driving habits will actively increase your monthly premium. One insurer might heavily penalize hard braking events while taking a lenient approach toward total mileage driven. Because these scoring formulas are guarded trade secrets, drivers often find it challenging to calculate their exact financial return in advance. Behavioral economics demonstrates that drivers alter their actions when they are aware that their movements are being actively observed. The immediate feedback provided by telematics applications encourages drivers to drop bad habits and maintain safe follow distances. Telematics applications require location permissions set to allow access continuously, even when the application is closed, so that trips are logged. Deciding whether to enroll ultimately requires balancing personal financial incentives against personal privacy preferences. Future telematics applications will likely integrate artificial intelligence to better contextualize driving hazards and defensive maneuvers. Thanks for watching the video. Subscribe this channel, like the video if you found the video great, and leave your questions in the comments.